How does the exit tax affect Americans renouncing citizenship? Have you ever wondered what happens financially when an American decides to renounce their citizenship? One major factor to consider is the exit tax. This tax is imposed by the United States government on certain individuals who choose to give up their citizenship. It is specifically designed to tax unrealized gains on worldwide assets as if they were sold the day before expatriation. So what does this mean for you? If you own assets that have increased in value, such as stocks, real estate, or retirement accounts, you may owe tax on that increase, even if you haven't sold those assets yet. This can come as a surprise to many. The exit tax only applies to individuals classified as covered expatriates. To fall into this category, you must meet at least one of the following criteria at the time of renunciation. First, you need to have an average annual net income tax liability above a specific threshold for the 5 years leading up to expatriation. For the year 2025, this threshold is $206,000. Second, if your net worth is $2 million or more, you will also be classified as a covered expatriate. Lastly, if you fail to certify that you have complied with all United States federal tax obligations for the 5 years before renouncing, you will fall into this category as well. If you are classified as a covered expatriate, the Internal Revenue Service treats all your worldwide assets as sold at fair market value the day before you renounce. You will then owe tax on any unrealized gains above an exclusion amount. For the year 2025, this exclusion amount is approximately $890,000. It is important to note that this tax is not a penalty. It is simply a final settlement of tax on gains accrued while you were a United States citizen. To complete the renunciation process, you must file Form 8854, the initial and annual expatriation statement, along with your final United States tax return. This form documents your assets, income, and tax compliance. It will also determine whether you owe exit tax. Filing this form accurately and on time is essential to avoid being automatically classified as a covered expatriate and facing unnecessary tax liabilities. For Americans planning to live, work, or retire in Europe, understanding the exit tax is very important. Proper tax planning before renunciation can help minimize or even avoid the exit tax legally. Consulting with cross-border tax advisors or attorneys who specialize in expatriation can provide strategies tailored to your financial situation and goals. There are alternatives to renunciation as well. You might consider maintaining dual citizenship, obtaining permanent residency in a European country, or restructuring your assets. These options can help reduce tax burdens without giving up your United States citizenship. In essence, the exit tax can significantly affect Americans who are renouncing their citizenship by imposing a tax on unrealized gains if they meet the covered expatriate criteria. Careful preparation and professional advice are key to managing these financial implications while transitioning to life abroad in Europe.